Well, hello everyone, and welcome to the Benjamin Z. Miller Investor Networking Group. It is so nice to have the different investors here from around the world. If you're watching this on the internet and you are interested in learning more about investing, and you also want to meet more quality investors, you should start coming to our meetings. We have our meetings every Sunday. They are free. You can come, you can learn some different investment techniques. You can network with some of the best investors in the world. We have investors, we have hundreds of investors, some of them from Europe, some from the Americas. And it's definitely something you should be taking an advantage of. Just send me an email, ben@benjaminzmiller.com. Just email me, ben@benjaminzmiller.com if you'd like a link. Be happy to send you an invitation. So today we are going to talk about currency trading, and I am going to show a brief video. It's about 6 or 7 minutes. This is about George Soros, and God knows we hear about George Soros all the time and all of the things that he's doing or not doing and how he's involved in so many things. But we're not going to talk about his politics here. We're going to talk about how he made approximately $1 billion on a trade when this happened in 1992. It's one of the largest successful currency trades in history. We're going to go through what exactly happened there, why did it happen, and then after that, we're going to talk about some of the dynamics with currency trading, what actually causes things to happen, and then we'll stop the recording and open it up for any questions. So let's go ahead and get started. I'm going to show a short clip here.
Aftermath of the Second World War, the nations of Europe decided that the only way to prevent the same sort of destruction from ever happening again was by banding together and forming a closely integrated union. The idea was that if the European economies all depended on each other, they'd be unlikely to start another war. The ultimate expression of this integration is, of course, the euro. But before the single currency was introduced in 1999, Europe had another system to manage its currencies. Back in 1979, the countries of the European Community weren't ready to give up their national currencies just yet, but they did agree to link them all together at a fixed rate, effectively removing the exchange rate fluctuations you usually have to consider when doing business across borders. This new system, known as the Exchange Rate Mechanism, or ERM, sounded good on paper and did make things easier for a lot of people, but it also made the national banks of these countries very vulnerable. You see, people buy currencies every day in vast volumes to fund imports or exports, and these transactions have a significant effect on the actual exchange rate you can get from the market. So once a country becomes a part of the ERM, it had to constantly monitor the markets and intervene if their exchange rate started to deviate too much. If too many people were buying, the national bank would start to sell, and if everyone was selling, it would go in to buy. Without going into too much detail, the ERM was flawed because every country is unique. It has to constantly balance interest rates, inflation, and economic growth, which it cannot do if its currency is artificially chained to others. Margaret Thatcher, the Prime Minister of the UK at the time, understood this very well, which is why she opposed it and why Britain wasn't a part of the ERM when it first began. However, as the British economy worsened towards the end of the 1980s, Thatcher's Eurosceptics lost ground to more pro-European members of the Conservative Party. By October 1990, Thatcher's power had diminished so much that Britain joined the ERM despite her opposition, thanks to the political power of John Major, the Chancellor of the Exchequer at the time. Less than a month later, Thatcher had resigned, and Major was selected as Prime Minister, hailing the ERM as his victory.
All my adult life, I've seen British governments driven off their virtuous pursuit of low inflation by market problems or political pressures. I was under no illusions when I took Britain into the exchange rate mechanism. I said at the time that membership was no soft option. The soft option, the devaluers option, the inflationary option, in my judgment, that would be a betrayal of our future at this moment. And I tell you categorically, that is not the government's policy.
But while November 1990 might have been the start of a very successful political career for John Major, it was just the beginning of Britain's economic problems. You see, when the UK joined the ERM, it was already in a recession. Now, when an economy is in a recession, the central bank, in this case the Bank of England, wants to cut interest rates to prop things up. But because of the ERM, it could no longer do that. The British pound was already a very weak currency, with the UK's inflation rate being 3 times higher than Germany's. If the Bank of England cut rates, it would help the British economy, but it would devalue the pound so much that Britain would have to leave the ERM, which of course John Major would never allow. And so, between 1990 and 1992, the British economy suffered. Of course, just keeping interest rates high wasn't enough to maintain the pound's value. And so, throughout these 2 years, the Bank of England would frequently go to the market and start buying up pounds by the millions, using up its foreign exchange reserves in the process. Even that didn't really help, though, since the pound continuously weakened during this time, just barely within the limits of the ERM. Pretty much every currency speculator understood that eventually the British pound would have to devalue. But the billion-dollar question was, when would that happen? The man with the answer was George Soros. He had been running his hedge fund since the 1970s, and his specialty was predicting and sometimes forcing the catalysts to big market events. He knew that almost everyone was ready to bet against the British pound if only there was some sort of bad news that could trigger a stampede big enough to overwhelm the Bank of England. Starting in August 1992, Soros and his fund began building a position against the pound. And here's how he did it. He'd go to a big bank or another hedge fund and he'd borrow pounds from them with the promise of repaying them with some interest on top. Then he'd go to the foreign exchange market and he'd sell those pounds to buy German marks instead. The idea being that when the exchange rate drops, he'd be able to buy back those pounds cheaper, earning the difference as a profit. By the end of August, Soros had slowly built up a position equivalent to $1.5 billion against the pound. But the exchange rate had barely moved. He needed some sort of news to really start increasing his position. And luckily for him, on September 16th, the president of the Bundesbank held a seemingly innocent interview that Soros could nevertheless use. The Bundesbank president said that he doesn't rule out that some currencies might come under pressure, which in and of itself is a very vague and unconvincing statement, but Soros decided that it was good enough for him. That same night, while Europe was asleep, Soros called up any international bank or company, or really anyone that had British pounds, and he tried to borrow them with great success. By the time the British woke up, Soros had sold the equivalent of $10 billion worth of pounds on the open market. Unsurprisingly, the Bank of England was in complete chaos. After an emergency meeting with John Major, the Chancellor of the Exchequer began a desperate fight. At 8:40 a.m. on September 17th, he authorized the purchase of £1 billion from the market to no effect. By 9 a.m., he had purchased another £2 billion, at which point he dialed John Major again to request permission to increase the interest rate, which of course, because Britain was in a recession, would be devastating to the economy. Initially, John Major refused because he thought it would be political suicide. But as Soros and the global currency market continued selling pounds, by 11 a.m., Major conceded, and Britain made a surprise announcement that it was increasing its interest rate by 2%, which is a very big increase. By the end of the day, Britain had purchased £27 billion and had increased its interest rate a second time to 15%. But just Soros alone had sold about half as many pounds, and by that point the entire world was following suit. At 7:30 p.m., the British government accepted defeat with the following news conference.
A unique day in London's financial markets ended with the Chancellor announcing that the pound was being suspended from the ERM and that the second of 2 dramatic interest rate rises during the day was after all cancelled.
Today has been an extremely difficult and turbulent day. Massive speculative flows continue to disrupt the functioning of the exchange rate mechanism. As chairman of the Council of European Finance Ministers, I have called a meeting of the Monetary Committee in Brussels urgently tonight to consider how stability can be restored to the foreign exchange markets. In the meantime, the government has concluded that Britain's best interests are served by suspending our membership of the exchange rate mechanism.
Over the next few days, as the foreign exchange markets were left to their own devices, the British pound fell by 15% against the German mark and by 25% against the US dollar. Soros and his fund pocketed a nice $1 billion from their trade, while the estimated cost to the British taxpayer was over £3 billion. Here's the funny thing, though. In the aftermath of Black Wednesday, as they called it, the Bank of England was once again free to control the British pound.
So that particular trade is one of the most famous in currency trading history. It's an absolutely amazing trade in terms of what was done. Now we're going to talk in general just briefly about what actually causes currencies to move in one direction or the other. Just a very brief introduction. So the simplest way to break it down is a good economy, the currency is going to increase. It's going to get stronger. A bad economy, it's going to go lower. And we'll talk about some examples of how that would work. And we're imagining a situation where we're discussing two paired currencies. So you're comparing country one and country two, what's going to happen with the exchange rate. So here's a good example. Let's imagine that the interest rates increase in the United Kingdom. Let's imagine that US interest rates increase. And let's say that UK interest rates don't change. Which currency is going to appreciate? Now, when we talk about this, this is only one of many factors, but we are imagining that all factors are held constant. So it's not just the interest rate that determines what's going to happen, but we're holding all the other factors constant. So the answer is, if the interest rate increases, that generates demand for that currency. And the reason it generates demand for that currency is people in other countries that think, well, you know, that's a higher interest rate than I can get in my bank. I'd like to put my money in a bank in that country and then I can get a higher interest rate. But in order to do that, they have to buy that currency. So the demand for that currency that offers the higher interest rate increases. Now, let's imagine that that situation happens. You're looking at a differential. So basically a higher interest rate it leads to an appreciation of a currency. That's essentially the crux of it. What about if debt levels increase? What happens if you've got two countries? Let's imagine the United States, and let's say that the United States gets into a situation where it starts accumulating a lot more debt. Maybe it becomes taking on an enormous amount of new government expenditures and debt. And the UK, let's imagine that everything stays stable. Well, if the debt levels are increasing in the United States, and everything's staying the same, the debt levels in the UK, the US dollar is going to depreciate in that situation. So in that case, the British pound would get stronger. Their debt levels didn't increase relative to the US. And that's basically due to the fact that as the debt levels increase, the risk in that country increases. An extreme example would be you see some of these African countries where they just go crazy printing money. And of course, that doesn't do a lot of good for their currency. So that's something that's relevant. What about export of goods? Let's imagine that the US starts exporting a lot more goods into the UK. So the US starts exporting and US starts manufacturing a lot more goods that the UK wants. And the UK starts buying these goods. What's going to happen in that situation to the US dollar and the British pound? Well, in that case, the US's currency can appreciate, and that's because as the UK purchases more goods, the demand for US dollars is increasing, because to buy the US goods, you need US dollars. So just like people are saying, I demand US goods, they're really saying, I demand US dollars. And as the demand shifts for US dollars, it increases. Now, let's take an example here, a more current example. Let's look at the exchange rate of we're looking actually the Russian goods and services. You know, after Russia started this brutal, vicious, evil war attacking Ukraine, all of a sudden there were a lot of sanctions that were imposed on Russia. And we have a nice graph here that shows we're looking at when Russia invaded back in February of 2022. And we can see here the trend. Look at this trend line. It basically was showing that the exports were increasing. So the exports were increasing, but then you notice the sanctions started increasing. Sanctions, all sorts of sanctions that were affecting Russian exports, where Russia couldn't export as much. And the trend actually reversed, where now we see it going down. So it was around, for example, 500 billion, 525, it's going up, and then it starts going down. And that's because of the sanctions. Well, when that happened, the sanctions, they reduced the Russian exports into the market. People are buying fewer Russian goods and services, and that caused the dollar, it's one of many factors, but that caused the dollar to increase against the ruble at that time. So the Russian ruble, it lost value compared to the US dollar. Well, the Russian central bank, they just didn't sit back and do nothing. They said, well, what we're going to do is we're going to increase our interest rate, because they thought, well, it may not be so good for the Russian economy if we increase our interest rate, but if we increase our interest rate, that should help us with our currency, where our currency doesn't keep going lower and lower and lower. So what the Russian central bank did was they increased the interest rate 350 basis points back in August 2023. So they increased their interest rate to 12%. And when they increased that interest rate to 12% here, we're looking at a chart that shows the US dollar, Russian ruble, the exchange rate. And you can see that once they made this increase, it was on the 11th of August, 2023, all of a sudden the trend reverses, where now the ruble's getting stronger. But that's not so easy to do with an economy, because that has a lot of bad effects for an economy. It causes all sorts of problems for an economy when you do that. The people in the economy, they don't like high interest rates. So another thing that happened was some investors sold Russian bonds at a loss. Now we're looking at a different chart here. We are looking at a chart where we're seeing that the bonds are being sold at a loss. So the bonds are being sold at a loss. When that happens, the yield on those bonds increases. So notice here, this chart is the yield, and the yield goes very high. It goes very high because people are selling at a loss. They're willing to take less than the face value, the par value of their bond, and that creates that high yield. That's the only way they can sell them. So it's definitely an interesting example. Now let's just talk about the Bretton Woods Agreement, which towards the end of World War II, when this was implemented, at that time, 1 British pound would purchase 4 American dollars. If we went back to the 27th of December, 1945, 1 British pound would buy 4 American dollars. But this agreement, it was set up with the idea that they wanted to link the exchange rates where they were fixed against the US dollar. The exchange rates of most of the major currencies in the Bretton Woods Agreement were fixed against the US dollar. And what happened was it was designed to prevent currencies from devaluing their currency. Now, why would a country want to do that? Well, there'd be a bunch of reasons that they'd want to do that. One reason would be if they just start printing a lot more money. That's a good way to devalue their currency. But it has another effect of it makes their exports relatively cheaper. So by linking everything, fixing it against the US dollar, they were trying to prevent this. But notice how much it changed over the years, where the pound got so much weaker and the dollar got so much stronger. Now, instead of a pound buying $4, a pound only buys $1.20 in the 1st of January 2023. That's very important. Now, another thing that's really, really important was in 1971, there was a major change in the United States. In the United States in 1971, there was the Vietnam War, and we had U.S. President Richard Nixon. We used to have our U.S. dollar linked to gold. It was the gold standard. We used to have the gold standard in the United States back in 1971. And at that time, $35 would buy 1 ounce of gold. And believe me, it won't buy anywhere near that now. But at any rate, this was a situation where they decided that they wanted to change this because there were all sorts of problems that were happening. One of the problems was it was so far from market reality that the French central bank started to purchase US dollars, then they would convert to gold, whereas they were holding a conversion at $35 to the ounce. But the market rate should have been $103 per ounce. So the French bank, they were very smart, and they actually just converted a lot of dollars into gold and shipped the gold to France. We have to give credit where credit was due, and that was a very smart move on their part. And they made out like bandits on that. So it worked out very well for them. But when they removed the gold standard, now we see something so interesting. You see here the Revolutionary War back in 1781 was the Battle of Yorktown in the United States. And at any rate, at that time, if you compared the US dollar, the rates of the CPI, basically inflation index, it was running through all these wars: the Revolutionary War, the War of 1812, the Civil War, major wars, even World War II, and relatively little inflation. Now, in 1971, when they released the dollar from the gold standard, that is where you got massive inflation. And I'll show you here some examples. These are prices back in 1971 in the United States. You could buy a new car for $3,500. You could pay rent of $150 a month. You could buy a new house for $25,000. And now these things are far more expensive. So in terms of forecasting the inflation rates, you can get a lot of information on this, and it can certainly be useful in terms of projecting what will happen with a currency. But most of the exchange rates now are floating. The Bretton Woods system, it's not in place the way that it used to be, but it's definitely something that's interesting to study. There's all sorts of examples of what will make a currency appreciate and depreciate. And I will email everyone a detailed slide. I don't want to go through every single example in detail, but you can read over these and get some good examples of what are real examples of a currency appreciating and depreciating. Balance of trade is one of the things that has an impact, where if a country is exporting more or importing more, this has a direct effect on the currency rate. It's relative difference between two countries. And of course, everyone knows about printing money. That one definitely causes some massive inflation. And the king of inflation is Zimbabwe. They have mastered the art of inflation at a level that is unprecedented. They were able to get the inflation rate up so high, it's just unbelievable. But it's an example of when you just keep pushing print on the printing press. So you can also increase the, why does an interest rate make a currency appreciate? This is a nice graphic for you to look at in more detail. It'll show how that works, but essentially you are moving the demand curve. So this little D, you're shifting the demand curve. If we're looking at, for example, dollars and pesos, if you increase the interest rate on the peso, the demand for the peso increases. So it's a shift that causes that. What about recession? Sometimes people talk about a recession and how that impacts the currency. Well, that is fairly simple. Basically, governments, when there's a recession, they want to do something to help the economy. And when they're sitting around saying, what can we do to help the economy? The idea that they come up with is, well, we ought to make money more readily available. Let's get the interest rates lower. As soon as they make the decision to get that interest rate lower, what happens is people from abroad, they are looking at that and they're saying, I'm not really sure that I want to move my money from my country to this other country, because before the interest rates were higher, now they're saying they're going to pay lower interest rates. Why don't I just take my money out of that country and go put it in a country that has higher interest rates? So you can see the demand actually shifts here. So if before you had an exchange rate of 1.50 pound to the US dollar, if you increase the demand, it's going to change to 1.70 pound to the US dollar. So that's an example. Here's another great example to look at. This is the hryvnia in Ukraine, and we are looking at a situation here where they actually made a decision to fix the exchange rate. So it was no longer a floating exchange rate. They fixed the exchange rate. The National Bank of Ukraine, they set the official exchange rate against the US dollar, and they held this, and you can see how it instantly had this impact. So it's definitely something where governments have a lot of control. A few terms that you should be familiar with if you're going to trade currency is you will hear things like bid and ask, and this is just simply the different prices that you get for, if you're selling something, it's the bid, and if you're buying something, it's the ask. The spread is what's between those. Major pairs like the euro and the dollar, they have a really tight spread, whereas if you go to more exotic pairs, the spread is going to increase. So if you looked at a pair like, say, maybe the Ukrainian hryvnia and some other currency that's not as commonly traded, you'll see a larger spread. One thing that gets a lot of currency traders is they love to use leverage. Their favorite thing to do, especially if they're new and they don't know what they're doing, is they open an account and they put $1,000 or $2,000 or $5,000 or $10,000 in the account. And then they think, well, if I can just make this go up by 100-fold, and they take out maximum leverage and they treat it like a casino. And that's never going to work. What's far better is to use very moderate leverage, but everybody likes to gamble. So that's kind of the situation on it. We also have a Discord group that you can get a link to. You can network with different people on our Discord group, and you can talk about deals. And if you are watching this on the internet and you think, boy, that's interesting, I'd like to learn more about that. If you are interested, I do offer a mentoring program where I can help you personally, get you started on the path. Just send me an email, ben@benjaminzmiller.com. Just email me. Be happy to help you. And that is it. So I'm going to go ahead and stop the recording, and then I'll open it up for any questions if anyone has any